Hello, everyone. I think I am live. Yes. Can somebody just drop me a comment or something if you can hear me? Thumbs up, anything like that? Just waiting. Let me sort my life out while those come through. Okay, I've got my books ready to go. Okay, can you hear me? Let's see. Can you hear me now? Yes. Okay. Thanks, Eloise. Thanks very much for that. Cool. Okay. So, welcome back to our live streams. Just some announcements before we get started. Okay. So, um, I've been thinking about what I want this to kind of be, like more than just deferred tax, just everything I do on the channel. And so I thought of one thing I can actually add to the channel is to go through illustrative examples like these, because I think sometimes when you read the examples in the standard, it's not always clear, and you just need somebody to give you a different perspective, because the way that it's set out in the standard is not necessarily the way that we have understood it, okay, or the way we've been taught it in our lecture content or in tutorials. So if that sort of thing interests you and there's any other illustrative examples that you would like me to cover on this channel, so I'll probably make videos and upload videos, then just drop a comment at some point to say, like, I want you to do illustrative example one of IAS 8, whatever the case may be. And then I'm going to do videos on those and post those videos. Yeah, so feel free to then share that content with your friends who are studying accounting, of course. And yeah, then in terms of this illustrative example, so with this illustrative example, I want to focus on calculating the deferred tax balance and how we pull that through to the disclosure, because I think it's really important to understand the presentation and disclosure. So what actually happens in the financial statements? What does it look like? Okay. Now, I would of course encourage you to go and look at a set of financial statements, and I find that Sasol Limited, they have really good deferred tax disclosures, so do go and check that out. But also go and look at different companies. In fact, you should be looking at financial statements, because if you're here, you're studying accounting. So if you're not looking at financial statements, then what are you doing? Okay, so in this example, though, it starts off with calculating current tax, and I'm not going to discuss current tax because we did do current tax last week. What I am going to do is I'm going to do a separate video after this. About the current tax. I will record that and upload that at some point, hopefully over the weekend. I just had a bit of a brain fart this morning and forgot to bring my charger to charge my laptop, but I think we're going to be fine and we're not going to run out of time here. Okay, so let's get started. Illustrative example 2. Now, let me make myself comfortable. Okay, so with illustrative example 2, there is a lot of information going on. And I think the first time I looked at the example, I was kind of like, whoa, what is going on here? There's just information coming, out of everywhere. And you're not sure, like, am I meant to have derived this number, or was this number actually given to me? And so I think I just want to kind of pull together where the numbers are coming from and what are sort of the key takeaway points from this example. Now, the first thing that I want to highlight in this example is that it does deal with the revaluation of a depreciable asset. So many of you don't know, in fact, all of you that are watching the live stream are not familiar with how to depreciate, how to revalue an asset that's being depreciated. Okay. However, I'm just going to take out the important things from that, and I'm not going to cover that. If you are interested in finding out how to revalue a depreciable asset, let me know and we can just do something like that for fun. Okay, because that's how we have fun here. We do accounting. Okay, so I'm going on and on again. If we want to understand illustrative example 2, right, we need to understand the key stuff that's coming out of there. And so the first thing is, if I'm thinking about deferred tax, what is going on with the deferred tax balance? Okay, just how I calculate the balance. The first important point is we've got to separate out which things are actually giving rise to a deferred tax balance. So I've prepared an Excel worksheet and I'm going to share it with you right now. Okay, so I hope that you are able to see that clearly. Just let me know if you can see that. I think it should be fine. I see there's an elbow cough over there. That's funny. Um, um, okay, I think people can see it. Oh, at least I hope so. Okay, so when I'm looking at the deferred tax balance, if I were to calculate the balance, now this is the sort of table that you're used to seeing. Okay, carrying amount, tax base, temporary difference, what's the tax rate, and then what is the deferred tax asset or liability. Well, at least the debit or credit. Okay. Now, if I look at year X4, so there's 3 years that we're actually going to look at when we calculate the deferred tax balance. The reason why we're looking at 3 years is because we're doing comparative, so we're looking at the disclosure for X5 and X6. But in order to understand the movement in X5, we must understand what the opening balance was, which would have been the balance at the end of X4. So in X4, there are only 2 things that actually give rise to deferred tax. So the first thing is the PPE asset that's going to give rise to deferred tax, and then there's the production development costs. Okay, so those are going to give rise to deferred tax. Why? Because those costs were capitalized and then they're being amortized over 5 years. So every year you're going to see an amortization expense coming through of 250. So in terms of temporary differences in year X4, these are the only 2 that give rise to temporary differences. Okay, so if I were to calculate then what are my temporary differences, it's the carrying amount is 36,000. So that's for the building and the vehicle. Yes, that's for those 2 together. So let me just format my okay, it's 36,000, and then the tax base is 15,000. Now these numbers are coming from those the whole table where they've done the calculation. Okay, don't get too confused on that table because, like I said, it does deal with the revaluation. Just go with me for now that this is the carrying amount and this is the tax base. Okay, so the temporary difference is that minus that. Okay, so there's a 21,000 temporary difference. That temporary difference, of course, is taxable or deductible. It's taxable. Okay, so why is it taxable? It's taxable because in the future we're going to have depreciation of 36,000, whereas we're only going to have deductions of 15,000 in the future. So in the future, my accounting profit is going to be lower than my tax profit because I have more depreciation in the future. So therefore, I expect to pay more tax in the future, okay, because the tax profit is higher. And so therefore, my temporary difference is taxable. Okay, so what is the tax rate? The tax rate in X4 was 40%. Let's just format this. Okay, 40%. And then to calculate the tax is that times that. And there I get a credit of 8,400. And then for the production development cost, the carrying amount was 500, okay, at the beginning, at the end of X4. And the tax base was 0 because we're only getting because it's not, what did it say? It said that it was not deductible. Sorry, let me just read my, okay, it says for accounting purposes they capitalized, These costs were deducted for tax purposes in X2. Okay, so the costs were already deducted previously. So we have to ask ourselves, this is an asset, what is the tax base? So the tax base, okay, it depends, are the FEBs taxable or are the future economic benefits not taxable? Now with production development costs, we would expect that the future economic benefits would be taxable, right? Because this is our intangible asset and we're going to use it. And so we would expect to pay tax in the future. So if it's taxable, then our tax base becomes the future deductions that we're entitled to. We're not entitled to any deductions, so therefore the tax base is 0. Okay, so what is our temporary difference? It's 500. The rate is 40%. And then I've got over there my tax. So if I want to calculate my deferred tax balance, at that point my deferred tax is 8,600 and that is a credit balance, so it is a liability. I'm just going to check out the comments to see if there's any questions. Okay, no, everybody's with me so far. Okay, then in year X5 there are actually 3 things that are going to give rise to deferred tax. So it's the PPE. Okay, it's still the production development costs that are coming through, and then it's the healthcare, like the healthcare. I'm sorry, there was the employee benefit. Okay, so with the PPE, okay, our new carrying amount is 37,200. Our tax base is 12,900. Okay, our temporary difference over there, and our tax rate in X5 is 40%. Okay, so there is my tax for my PPE. Now for my production development costs, the carrying amount now is 250 because I'm amortizing every year 250. Tax base is 0 for the same reason. It's been 0 in the prior year. Temporary difference, tax rate, deferred tax. Okay, now with healthcare, what's crack-a-lacking over here? Okay, so we've got a liability of 2,000. So I just want to find the notes over here. So I've got a book. Obviously, I don't have the electronic version. Where is the healthcare? Okay, in X5, so I'm looking at page B609. So it says in X5, the second paragraph, they entered into agreement to provide healthcare benefits. So the entity recognizes as an expense as part of the cost of service provided. The healthcare costs are deductible for tax purposes when the payments are made to retirees. So we have at the end of the year we have a liability of 2,000. Okay, now what is the tax base? A tax base for the liability is the carrying amount less the amounts we'll deduct in the future. So in the future when we pay the 2,000, we're actually going to get a deduction for it, so we're getting a deduction for the full 2,000 in the future. So what is the tax base? It's carrying amount 2,000 minus tax base minus the future deductions, which is 2,000. So my tax base is 0 again. Okay, so I've got a temporary difference of 2,000. Now, is this temporary difference taxable or deductible? Drum roll, it is deductible. Okay, why deductible? Not because it's negative over there. Okay, we need to be able to understand why things are taxable or why they're deductible. So this temporary difference is deductible because think about what's going to happen to our tax profit in the future. Okay, in the future, I am going to pay this expense out. Okay, so I'm going to pay the cash and then I'm going to get a deduction in the future. So in the future, I'm getting a deduction, which means that my future tax profit is going to be lower, right? It's a benefit. So I expect to pay less tax in the future. Therefore, my temporary difference is deductible. Awesome stuff. Okay, so that gives us our deferred tax over there, and that again is a liability. Okay, we have a liability at the end of X5. Okay, then in X6 Okay, we only have two things that give rise to deferred tax. So it's the PPE and it's the healthcare benefits. Now, the production costs, those have been fully amortized. So at the end of the year, there's no carrying amount for the production costs. So there's no deferred tax. Okay, now with the PPE, the new carrying amount for PPE is 75,750. The tax base is 16,050. Okay, temporary difference is 59,700. Now, what is the tax rate? So we are told that in X6, the enacted income tax rate was 35% of taxable profit. Okay, so now we actually have to recognize, we have to calculate our deferred tax at 35%. Okay, so let's just copy that down there. Okay, so that gives us that deferred tax over there. For the healthcare, the carrying amount of my healthcare liability now is it was 3,000. So last year it was 2,000. This year it's 3,000, which means that in X6 we must have recognized an expense of 1,000 because we would have debited the expense, credited the liability. So that would have been the movement. Sorry, I'm getting ahead of myself. Just confusing myself. The carrying amount is 3,000. Okay. Tax base again, it's 0 because we're going to get deductions in the future. So carrying amount minus future deductions equals my tax base for a liability, 0. Okay, temporary difference. That temporary difference, again, it's deductible because in the future I'm going to pay less tax because I'm getting my deduction in the future. And then my carrying amount over here of my deferred tax liability now is 19,845. Okay, so this is what our deferred tax balance actually looks like. Okay, so here I've skipped a whole lot of pages of information and I've just condensed it down to actually this is what our deferred tax calc looks like. So I'm going to take any questions now. Let's see. Okay, so if my temporary difference is negative, the deferred tax asset, it's a deferred tax asset. If it's positive, it's a deferred tax liability. Is this how it is all the time? Okay, so what I want to discourage is memorizing that positive means taxable and negative means deductible. Okay, because I want you to really grapple with why it's taxable or why it's deductible. Because if in a test or exam we ask you to explain how to calculate the deferred tax balance, you need to be able to explain why it is taxable or why it is deductible, and that's why I stress that. Now, in the way that I've set up my my deferred tax calc, I make my liabilities positive. I make my assets positive and my liabilities, I make them negative, right? And so because of the way I've set up everything, my temporary differences, if they come out positive, they tend to be taxable, and then if they come out negative, they are deductible. So yes, the way I've set out my calculation, it's going to be that way. However, I don't want you to default to that understanding. Rather understand what it means for a temporary difference to be deductible and what it means for temporary difference to be taxable. Okay, I hope that answers your question. Then I've got another one here. Please re-explain how you got to 3,000 for healthcare. Okay, so for healthcare, I'm sorry, I just want to look at the information. Because I want to find it for you. Okay, so on page B615, okay, we're given in their deferred tax calculation, we're given that the carrying amount for the liability for the healthcare benefits is 3,000, right? So that's given to us, okay? But I was just talking about the fact that the movement, okay, there was a 1,000 expense that we recognized in the current year because last year it was 2,000. This year they've told us it's 3,000, so there was a movement of 1,000. Okay, I hope that answers the questions. Now that so now I'm going to go back. I'm going to go back to my deferred tax calc, my workings. Now, let's continue. Okay, so now we've calculated our deferred tax balance. But the next step is to do this T account, okay? Now we are accountants, we love our T accounts. And I think it's really great if you can think of accounting in terms of a T account. It just helps pull things together. So let's talk about the deferred tax in the statement of financial position. If I were to draw up the general ledger account for deferred tax, what would it look like? Okay, so at the beginning of X4, right? So I'm just going to put here X4, oh, sorry, X4, okay, my opening balance. Of course, this would have been balance brought down, whatever, right? This account is not meant to look exactly word for word like it would look in the general ledger, but I'm just trying to, this is my workings. I can put whatever I want in my workings, right? So I like to just put opening balance like OB, CB, closing balance. Okay, so my opening balance, I calculated it. It was this number here, right? So it was that number. Okay, so that is my opening balance. Then my closing balance is a credit. Okay, and it was that number over there. So now I need to ask myself, right, this difference, like how did my deferred tax move? Well, in X 4, we were not given any information about any items that would have been recognized outside of profit or loss, right? All the temporary differences that we had actually related to things that were recognized in profit or loss. Okay, how do we know this? The PPE at that point, okay, there was no revaluation, so it was just normal wear and tear, and the depreciation would go through P&L. The product development costs, though, that amortization went to P&L. So we know that the movement over here, okay, which is that minus that, okay, that movement must be what went through profit or loss. So that's my deferred tax in profit or loss. Let's call it deferred tax in profit or loss. That must have been my expense in profit or loss. Okay, now next year, okay, so you can see I've got the different colors here for the years. So this year, okay, we're looking at X5. Yeah. 5. There we go. Okay, so we've got an, oh no, I can't copy that. Opening balance of that over there. Okay, so there is my opening balance. Now, what is my closing balance? Let's put it. Okay, closing balance. My closing balance is that over there, the 19,845. Okay, now I'm trying to recreate what happened to deferred tax. Okay, so there were a couple of things that happened. The first thing that happened was, okay, we know that the tax rate changed. So the tax rate went from 40% to 35%. Now, my opening balance that was calculated on a 40% tax rate. Okay, so we can see over here, we calculated the opening balance on a 40% tax rate. But this balance, right, is accounting for future tax consequences. So if now the tax rate has changed, it means in the future we expect to pay this tax at a different tax rate. So we need to adjust that opening balance for the impact on the tax rate. Okay, now it went from 40% down to 35%. Okay, so that is going to be a decrease in the balance, right? So over here on this side, on the debit side, I'm going to have a change in rate. Okay, now my change in rate, all of my change in rate went to profit or loss because all my temporary differences in the prior year were all items that went through profit or loss. So the impact of the change in rate, all of it gets recognized in profit or loss. Okay, so how do I calculate my change in rate? Okay, so I'm going to start with a little calc over here. So I've got my balance is 9020, okay, and I've got to multiply it by something, okay. Now, the first thing is I'm going to multiply it by the difference in the rate, which is 5, right? So how many points did the tax rate change by? It changed by 5. It went from 40% to 35%. It went from 5. And I'm going to divide it by the difference, by the old tax rate. So what was the old tax rate? It was 40. Okay. So that's just a little working over there. So it's going to be 5 divided by 40 times 9020. Okay. So the movement in my tax is 1125. Now in there, it's actually 1128. If you round it, they've rounded it to 1127. But we're just gonna I'll just leave it like this so you can see the comma space. Okay, now I'm going to repeat what I did there because I know a lot of students get confused with how we get to this calculation. Okay, what we're doing in this calculation, just look at what we're doing. Okay, we're saying that we've got the balance of 9020, right? That was the opening balance of deferred tax. If I just look at the divide by 40, if I take the balance and I divide it by 40, what am I doing? I'm actually calculating all the temporary differences, right? Because to get to that balance, so there's the balance over there. To get to that balance, I multiplied all of the temporary differences by the tax rate. So when I divide that balance by that over there, I actually get all the temporary differences, right? And those temporary differences now, I actually want them multiplied by 35%. Okay? So I could multiply by 35% and then subtract from the opening balance, or I could just say the difference is actually 5%. So I'm just going to take the difference of 5% and subtract it from the opening balance, and same thing. Okay. So that gives me my change in rate. Any questions? No. Okay. I'm just going to continue, and then at the end of this, I'll go back to questions. Okay, so now I've got the change in rate. Oh, something in my eye. Sorry. Okay, change in rate. Now, what else happened in the year 20x6? Okay, what happened? Firstly, there was a revaluation. Okay, now we revalued our PPE. Now remember I said we don't actually need to know about the revaluation of the PPE, but it's important in this question because when we revalued the PPE, that revaluation gain that's recognized in, where is it? Other comprehensive income, gave rise to deferred tax. Correct? Okay. Now, what is the principle? The principle is that wherever the transaction went, okay, let me see, wherever the transaction went, there goes the tax following the transaction. Okay, so they go like that, they follow each other. So if the revaluation gain went through OCI, then the deferred tax also must have gone through OCI. So my deferred tax balance actually increased because there was deferred tax in OCI. Okay, how do I calculate that deferred tax in OCI? Okay, my revaluation gain, so this was calculated for us, but let's just take it as given because we're not going to get into how to do that because you don't need to know how to do that. But remember, if you do, you can drop me that comment and we can have a lacquer chat later on. I can do a video about that. Okay, so the revaluation gain is 31,800. Then I multiply it by the tax rate. Okay, what is the tax rate? It's the 35%. So the tax that went through OCI was 11,130. Okay, so that's the tax that was recognized in OCI. Right. Now, what else happened? Okay, was there anything else that happened besides for the change in tax rate and besides for the revaluation that went through OCI? Everything else went through profit or loss. Okay, so therefore my balancing figure, okay, must be my deferred tax. Okay, let's just I use wait Match destination formatting. There we go. Okay. My balancing figure must be the deferred tax that I had in my profit or loss. Okay. So it's going to be the sum of that minus. Okay, I'm just balancing this account. Quick. Okay. Balancing figure there is 823. It's actually 822.5, and that's why in the standard in the example they use 822. They've just rounded it incorrectly. See, sometimes even the accountants can get the numbers wrong, but we are here to check up on the IASB and tell them update your numbers. You cannot round correctly. Okay, so that is how we calculate our deferred tax balance and how we recreate the movement in deferred tax in the ledger account. Okay, before I move on and go to the disclosure, okay, I just want to see if there's questions. Okay, how would you apportion the effect of the change in tax rate if not all of the prior temporary differences went through P&L or OCI? Okay, I like this question. So, if a portion of those differences went through OCI, what you would need to do is you would need to separate out what went to OCI. So, going back to this calculation over here, right? You would have, let's say, and in your case, the only thing that would go through OCI would be land, okay? Because you're not revaluing other PPE assets. So for the land, you would have to go look in last year, what was the temporary difference on that, and then calculate the new change in rate specifically just to that temporary difference. And then over here, you would have a change in rate, OCI, and you would have that portion over there. And then the difference is what went through P&L. Okay, so I think what you'd first do, probably the best thing is calculate the full movement, the full impact of the change in rate on the balance. Then look at the temporary differences that were outside of P&L. Calculate what the change in rate would be on those temporary differences, subtract the one from the other, and then you get what is your change in rate in P&L. So you would then have change in rate P&L, change in rate OCI as well. Okay, I hope that answers your question. Cool. So, okay, now we're going to move on to the disclosure. Now, why did I recreate my ledger account over here like this? It's a bit of a messy ledger account, but it works. Okay, the reason why I have to recreate this account as it is, because this is going to give me all the information I need to properly disclose this thing in the financial statements. So why am I separating out the change in rate, what went through OCI, what went through P&L? I'm separating those things out because each of those things are separately disclosable. Okay, so if something is separately disclosable, okay, we're going to record it separately so that we can pull it through to our disclosure much easily. So let's move on to the disclosure then. Okay, the first disclosure we're going to look at is the major components of tax expense. So tax expense, major components, what do we know? Okay, major components are actually, oh, that's too dark. Let's just make it a bit brighter. Let's do yellow. Okay, so the major components of tax expense are actually current tax and deferred tax. Current tax plus deferred tax gives me tax expense in the statement of the statement of profit or loss and other comprehensive income, or your income statement, or whatever we're calling it these days. Okay, so this tax expense over here, this is what is in profit or loss. Okay, what is in profit or loss? Current tax plus deferred tax. But what can we see here? Under deferred tax, I'm separating out what actually made up my deferred tax movement. So if I go back to my workings over here, two things went through profit or loss. Okay, it was that and the change in rate, right? So my deferred tax expense actually in P&L was made up of a change in rate and a movement in the temporary differences. Okay, so let's let's start populating numbers. Now, current tax, I said we're going to get to that calculation. So I'm just going to plot in the numbers that they did calculate for current tax. It was 3570, and then in X6 it's 59. Okay, so these numbers were previously calculated, but I'll do a separate video on how to calculate the current tax for those that still need a bit of extra help with that. Okay, so now that gives us our deferred tax. Okay, now what is the change in the rate? Okay, so the change in rate, okay, it was 1127.5. So I'm just going to say 1127 for now because that's how it's been rounded in the standard. Okay, so the change in rate in X5, there was no change in rate, but it's 1127 in the prior year. Okay, so that gives us our, now the 1127, let's have a look over here. It's sitting on the debit side in my statement of financial position. So if I debited my liability, I must have credited my expense. So if I credit my expense, then this is actually a minus. Okay, because I'm reducing the expense. Then the movement in the temporary differences, let's go look. Okay, last year it was 420. This year it is 822. Okay, so last year it was 420. This year it is 822. And look at that. Now we know if we were looking at the income statement, that is the tax expense that we expect to see there. It is the current tax plus the deferred tax. Okay. Any questions? Okay. Could you just make up random numbers to show this visually, please? Daniel, I think you're referring to the OCI. Okay, so let's just go back. Okay, so let's say sorry, my full change in rates was 1127. Okay, let's just imagine that was my full change in rate. Sorry, let's put it over there, 1127. Okay, now let's say that was the full change in rate that I had calculated on the balance. So what I would do is, let's say there was land over here. Okay, so let's just, I'm imagining, let's say there was land, and let's say there was a temporary difference of 500. Let's just, okay, for argument's sake, I think I should highlight this maybe like different because it's not part of the calculation, it's just extra. Okay, so let's just say it was 500. So then you would go and calculate, okay, on that 500, right? Sorry, OCI. Okay, on the 500, what is the impact of the change in rate? It would be 5%, right? That's the difference. Okay, because that's my temporary difference of 500 times 5%. So that would be the impact of the change in rate. It would change my deferred tax from 500, it equals 500 times 40% to 500 times 35%. Let's just do an equals. Okay, so there you can see the difference between that is the 25. Okay, so there I've just taken what my temporary difference is minus my multiplied by the 5%, and then I would say therefore P and L must be the total movement minus what went through OCI, 1102. Okay, I hope that illustration over there helps. Okay, cool. Moving on. Okay, now another disclosure which you need to do is the tax in other comprehensive income. Now this disclosure, there's a specific paragraph to which this refers. Okay, it's referring to paragraph 81AB, and so this number you just need to kind of take this as a given. Okay, because what they've done is they've taken the the OCI number right over there. That was the gain that went through OCI, right? Because remember, we're taking the gain as given, it's been worked out already. We multiply it by 35%, okay? So the deferred tax that went through OCI was 11,130. So it's 11,130. Okay, that is my deferred tax in OCI. Cool. Then we need to do the tax rate reconciliation, but this is the one where it gets a little bit interesting. So I am going to do that one last. And I'm just going to move on to the balances. What's going on here? Oh, silly me. Equals sum. Okay, sorry. Moving on to the deferred tax balance disclosure. Okay, now what we need to do is we need to say in my statement of financial position, right? What am I going to have there? I'm going to have in X5, I'm going to have a liability of 9020, and in X6, I'm going to have a liability of 1984845. So that's my liability, right? I'm just going to put it over here, equals that one, and equals that one. Okay. Now, what this disclosure, this paragraph is asking us to do is we've got to disclose what made up that deferred tax balance. Okay. So, what were the temporary differences then that went into the deferred tax balance? So, the first thing is, okay, we can say it was the PPE accelerated allowances. So let me explain what this is, right? This refers to the fact that we are depreciating PPE at a different rate to the wear and tear allowances that we're receiving. So because of this difference, we have deferred tax, right? So now we're saying, okay, PPE accelerated allowances, that is giving rise to deferred tax. That's a temporary difference that gives rise to deferred tax. What else? If we go and look at our calculations here, right? So it's the PPE, it's the production development costs. So we're just going to list over here, okay, production development costs, and then it's the healthcare. Okay, so just look at what I'm doing here. All I'm doing is I'm saying these things, the PPE, the production development costs, the healthcare, PPE healthcare in year 2, these are the things that had temporary differences on them. So therefore, I'm going to separately now disclose the impact on my balance. There's another thing that also impacted the balance, and that is the revaluation. The revaluation of PPE. Okay, so the revaluation also gave rise to deferred tax that's sitting in the balance, because remember we had that revaluation over there, which is 11,130. Okay, so that deferred tax is also sitting in our balance. So now the question is, which numbers do we pull in here? And the nice thing is that we've actually already calculated these numbers in our calc over here. So we go back and let's look at the production development costs. In X5 we had 100 deferred tax. In X6 there's 0 deferred tax. So for the production costs we're going to say 100, X6 0. Okay, we're going to go to our workings again. We're going to look at healthcare. Last year it was minus 800. This year it's minus 1050. So it's healthcare minus 800 minus 1050. Okay. Then revaluation of PPE. Now remember the revaluation of PPE, the total deferred tax that we calculated over there was 11130, and I said that was based on the revaluation gain. Excuse me. Now when we disclose this revaluation of the PPE, there's one other thing we needed to take into account, and that was the fact that there was a release of the revaluation surplus. Now, I'm not going to get into that release because, of course, you don't need to know about it. But all you need to know for the purposes of this discussion is that we're going to take the 11130 minus the 557, which the question told us was released. So actually the revaluation of PPE was 10573. Okay. Now again, don't get too confused about this, because when you have your land revaluation, it's going to be easy, right? So let's say I had my land, which is 500 over here. I multiplied by 40%. That would have given me deferred tax of 200. So I can easily pull in 200 over there, right? But I don't have that in this illustrative example, so I'm just working with the numbers we've got. Okay. Now, the difference then, okay, to get from this is what it should be in the, because those are the numbers we previously calculated as what the liability is currently sitting at, right? The balancing figure is basically going to show up over here in the PPE accelerated allowances, because that's the only thing that is different. Now, the nice thing is that because you don't deal with depreciable assets being revalued, whatever you calculate for your PPE temporary difference in your calculation over here, that number you would you then just straight pull through. Okay, so we look at the 9720 in the prior year. We'll pull through 9720 over there. And then in the current year, okay, it's the 20895, but remember we can't use the 20895 because the full PPE includes both the accelerated allowances plus the impact of the revaluation. So we just do the difference, okay, between that and equals that minus that difference there is the 10322. Okay, so again, like I said, this issue here in X6 makes it a bit tricky just because there's a revaluation, but don't worry about that because you don't actually need to know that because you're not going to revalue a depreciable asset. You will, however, revalue land, but on land there's no depreciation, so it's going to be a lot simpler. Okay, what is the point of this this over here, okay, with this disclosure? It's just saying this is the balance in the statement of financial position. Okay, that's the balance in the statement of financial position. How did you get that balance? You got that balance by the temporary differences. And where is that coming from? Easy peasy. It's coming from your calc over there. So that's why it's so important that you set out your calculation like this, okay, and you do your T account like that, because then the numbers are just, you know, pulling through easy peasy. Okay, let's take a quick question. Okay, why is the tax on the revaluation of the building in the tax on other comprehensive income a negative figure? Okay, because if you have if you think of what OCI would look like, so in OCI you would have revaluation gain, whatever the number is, and then tax on items in revaluation would be a negative number. Okay, because we subtract it. And so that's why in the disclosure we just put it as negative, because we're just linking that number up to what's sitting in OCI. Cool. Okay. Next. Okay, tax rate recon. This is where things get interesting. Okay, now students get confused with this, but I know you've watched the video, so you've watched Gulam's explanation, so you kind of have you have an understanding, and now it's just about, can we take what we understood from that video and can we apply it over here? Now, the tax rate recon, the important thing to note is in this illustrative example, it's showing you the disclosure when you do the reconciliation by amount and by rate. Now, in a test or exam, we ask you for either one of those because the standard in paragraph 81C, it tells you you need to do the tax rate recon, but it's an or. So you can either do by amount or by the rate, okay, whatever you choose. However, in the test or exam, we will choose for you, so we will tell you which one. But let's do both. Okay. So, what is a tax rate recon doing? A tax rate recon is trying to reconcile the tax that we see on the on our income statement or in profit or loss. So that 3390 over there, sorry, 3990, and that 2054. So that's how I've put it here as actual expense, right? We are trying to reconcile that number to what we expect our tax to be. So what do we expect our tax to be, okay? If we look at our financial statements and we see there's profit before tax. In X5, the profit was 8775. Okay, so that's our profit before tax. What do we expect to pay on that? We expect to pay 40%, right? So that is the expected tax. We expect our tax must be 3551. Similarly, in X6, our tax is our accounting profit is 8740, and our tax then is 35%, because that's the new tax rate. Now, can you see that what we expect tax to be, okay, versus what the tax expense actually is, it's different, right? And so now we need to explain to the users of the financial statements why is there a difference between what we expect the tax to be and what the tax actually is. Okay, so the difference, let's think about what the differences were. Okay, the first thing is we're told in the question that there were charitable deductions, and those deductions were not charitable donations, and those donations were not allowed. So we have the deductible expenses, okay? And let's do our charitable donations, okay? Now, in South Africa, okay, if you're donating to your section, what is it, section 18? I forget. Anyway, when you make donations to an approved organization, then you would get a deduction. But remember, this is now the example. Okay, so the charitable donations were not allowed. So what's the deduction? Okay, so if we're looking at our charitable donations, so now we need to go back to our calculation for the current tax. So in the current tax, okay, in year one, in X5, we made a donation of 500 Rand, right? So that 500 Rand is sitting as a deduction. It's sitting as an expense in my accounting profit, but it's not sitting at the end in current tax, right? It's not sitting in current tax. So the 500 donation, we actually need to add that back because that wasn't a deduction given to us. So it's going to be the 500 donation times the tax rate, which is 40%. So we're going to add back 200. Similarly, in year X6, we had a donation of 350. So we multiply that by the tax rate of 35%. Okay, so they, again, not so great on the rounding. Okay, they use 122, so let's just go with that for now. Okay, but it's technically 123. Okay, what else was there? There was also the fines. Okay, so the fines were not allowed as a deduction. If we go to our question, we see that in our current tax, we calculated the fines as, it was 700 fine. Okay, so it's 700 multiplied by the tax rate, which is 40%. Okay, so we add back 280. So that's non-deductible expenses. Okay, then what else was there? Okay, so if we look at this first, if we look at X5, right? If we add those up, we can see they sum over there at the bottom to 3990. So actually this year, the first year, X5, that thing perfectly balances. Now we've perfectly explained the difference. However, if we look at X6, we don't actually have, it doesn't reconcile yet. There's something else that's missing, okay? So what happened in in X6 that has an impact on my tax? Okay, now I want you to look up here. Can you see that? The change in the tax rate, okay? Think about the impact. In my expected tax, right, I've got my accounting profit multiplied by 35%. So I've calculated my expected tax as 35%. But in my end result, my actual tax expense, right, I have got the impact of the change in rate. So in the starting point, there's no impact of the change in rate because I'm using a new rate. But in the end point, my deferred tax actually accounts for the change in rate. So that must be a reconciling item. Okay, because it's not in my starting point, but it's sitting in my deferred tax in my end point. So it's 1127. And now, how would you have that? Look at that. Beautiful reconciliations happening. I'll take questions now. Okay, let's see. Is there any way your video block doesn't block the info you're typing in the Excel spreadsheet, please, for recon? What? Is there any way your video block doesn't block the info you're typing? I don't know. I'm not sure what that's referring to. Let me see. Are you not able to? Okay, so I'm not exactly sure what that's referring to. Yeah, maybe we can, let's maybe send me an email or something, then I'll just call you so you can just explain to me what it is I'm not seeing, because I don't know what you're seeing versus what I'm seeing. Yeah, it looks a bit different. Anyway, sorry, I have to go to a meeting, so let me actually finish this explanation over here. But there were no other questions on the rate. Okay, now this is the disclosure if we do it by the amount. Okay, the other alternative we have is that we can do it by rate, meaning we take the tax rates and we reconcile the tax rates. So in X5, okay, what do we expect our tax rate to be? We expect a tax rate of 40%. Okay, sorry, let's do this. As percentage. Okay, so we expect our tax rate to be 40%, and in year 2 we expect to see a tax rate of 35%. Now, what is our tax actually? What is our effective tax rate? Our effective tax rate is actually what the tax expense was divided by the accounting profit. So the accounting profit was 8775. Okay, sorry. Let's take the 3990 divided by where's the 8775? I need to just gonna do that so you can just see some sport. Okay, so in year X5 we effectively paid 45.5% tax. In X2 it's 2054 divided by the accounting profit before tax 8740. Okay, so in X5, in X6 we have an effective tax rate of 23.5%. So now we must explain, why did I think my tax rate must be, why is the tax rate 35% but we actually ended up paying 23.5%? We must now explain the difference, right? So the difference comes through in, okay, firstly the charitable donations. Okay, so with the charitable donations, firstly, all you're going to do is you're going to take the 200, oh wait, I don't want, sorry, it's confusing me. Okay, so it's going to be 200 divided by the accounting profit before tax, which is 8775. Okay, and that gives us 2.3%. Okay, so the effective change on the tax rate is, so it's just taking that number divided by the the tax. Okay, again, we take that number, the 122, we divide it by the accounting profit before tax, which is 8740. Okay, that gives us 1.4, 1.4%. Okay, next we take the fines. Okay, we take the fines. We say it's that number divided by the accounting profit, which is 8775. Okay, percentage, move it like that. And then we're going to take that number and divide it by the accounting profit, which is 8740. Okay, and it's like that. Okay, so there's our 12.9%. And now if you sum up the first column over there, you see that it reconciles to 45.5, and the second one reconciles to the 23.5%. And that is how we do the tax rate reconciliation by using the rates. So it's important that you actually understand both of these. Okay, I need to jump into a meeting, but let me take quick questions before I go. Okay, we are not able to see the tax rate recon. Oh, sorry, my bad. Oh, sorry. Okay. I am so sorry. I just I wasn't able to see that. Okay. Let me just re-explain here so now that you can see. Okay, so big picture, what have we done? We looked at our expected tax, which was the accounting profit before tax times the tax rate. Then we had our actual tax expense, which was coming from up here in the major components, okay, which is sitting in P&L. We used our deductions that we got out of our current tax calc. We applied the tax rates and then we reconciled it over there, right? We also had to account for the change in the tax rate because it's not sitting in my starting point, but it is sitting in my end point. How do I get from here to the recon? I'm taking these amounts over here and I'm dividing it by the accounting profit before tax. Okay, can you see there? I will post this example, the memo to Vula afterwards, but I mean, well, not immediately afterwards. I need to jump to a meeting. Sorry, I'm running late. And then, yeah, that's the tax rates over there that's been reconciled. Any other questions? Sorry, Jitsa, I wasn't understanding. But thanks, Daniel, for clearing everything up. Okay, so I can't stay long for questions. Because, yeah, I have to go into this meeting now. But thank you so much for joining me. I'll make sure I post all of this on Vula. And I will see you next time. Okay, bye-bye, everyone.